Okay, good morning, everybody. This is Tom Bowley, Chief Market Strategist with EarningsBeats.com. And this is the second mini-series event of the Market Vision 2020. For those of you who are unfamiliar, Market Vision 2020 is an event that will be held on Saturday, January 4th, 2020, bringing together just a slew of great technical analysts, experts, who are going to give you their thoughts about the year as we open up 2020. It's a pretty exciting decade coming up, especially with the market breaking out to all-time highs. We have a featured keynote speaker, John Murphy. I'm really excited that John has agreed to join us. I'm pretty much a self-taught technician, but I have been heavily influenced by John's work. I've read his books. He's just a tremendous analyst. A lot of the relative strength work I do, and a lot of the ratios, looking at different markets and how things are performing relative to other things, all of that really stems from the work that John did. So really excited to have John Murphy as our keynote speaker. I want to also wish all of you who celebrated Thanksgiving yesterday, happy Thanksgiving. And just want to thank everybody for coming out today for the event. I mean, it's a pretty exciting day for us at EarningsBeats. This event is very exciting for us. It's our first online conference. And so we're really glad that you've taken the time out of your day to be here with us today. We are going to have a drawing. I just want to mention this. We're going to have a drawing for 4 quarterly memberships. The drawing that we're going to have takes place from those who received the newsletter this morning, the newsletter article that went out on the Market Vision 2020. In there was a poll, and if you complete the poll, that is how you are eligible for the quarterly prizes. So there are going to be 4 of them. If you're an existing member, you'll simply have 3 months added onto your membership at no cost. If you're a new member to EarningsBeats, you'll get 3 free months. Simple as that. Now, if you are joining us today from my blog article this morning and you're not already a subscriber, we're going to be entering you for the newsletter going forward. We have a page that keeps track of everything. I'm not quite sure. If you don't see the poll in anything that you get on Monday or Tuesday, or it would actually be on Monday. If you haven't seen anything about the poll by Monday, and maybe even right after this webinar, why don't you send an email to support@earningsbeats.com and just let us know that you're being added to the newsletter. You'd like to be part of the drawing, and we will make sure we get the poll to you in one way or another. Okay, so just make sure that if you weren't already subscribed and you didn't get the newsletter this morning, then make sure that you send us an email at support@earningsbeats.com. We'll make sure we get that to you so that you can be part of this drawing. The a quarterly membership at EarningsBeats is $291 based on $97 a month membership. So 4 of those, you can see that's almost $1,200 in giveaways. So make sure you sign up for that. Again, as I mentioned at the start, this is the second of 7 mini-series events that are currently scheduled. The whole idea of these mini events is to allow each of you to gain some familiarity with each of the speakers and our styles and strategies so that when we give our forecasts for 2020, you'll have a little bit better foundation and understanding of how we approach the market. All of these mini-series events are free. All you have to do is just be registered to our the free newsletter, the Market Vision 2020 newsletter. And again, for those of you that were not registered but are coming in here, we'll use that email address that you used to get in, and we will make sure you are subscribed so you don't miss any of these events, don't miss the drawings. Everybody, all the speakers are going to be doing these free drawings. So a lot of great value going to be given away as part of this. So we do really appreciate your participation in this. Also, I want to mention today is starting Black Friday. It is a special for the Market Vision 2020. I'm sure you're going to hear a lot about it here over the next couple of days. We want to make sure that everybody, if you're interested in coming in, gets the best price possible. And as part of that, I also want to mention, and I'll talk about this a little bit later as well, If you are a non-member of EarningsBeats.com and you sign up as a non-member, you can save $20 by being a member, and we have a $7 trial offer. So if you do the simple math, you try us for 30 days, pay us $7, you'll save $20 on the event itself. So in essence, we're going to pay you $13 to try our service. That seems like a no-brainer. But anyway, I wanted to mention that so you can understand. If you have already signed up, paying the non-member price, sign up for the $7 30-day trial, and again, send us an email at support@earningsbeats.com. Just tell us that you signed up as a non-member for the event. You are now a trial member, and we'll make sure you get refunded that $20. Okay, well, it is my turn to present my mini-series event, so let's go ahead and get to it. It is the creation and design of a winning portfolio. About a year ago, here at EarningsBeats.com, I had presented a portfolio of what I call my model portfolio. And that was born out of members wanting to know my favorite stocks. I keep a strong earnings chart list, but that can vary anywhere from probably 125 stocks to as many as 325 stocks on a chart list that we use and that we are constantly evaluating, looking for possible trades and so forth. But the list, if you're looking and you say, okay, well, I want to invest, but I want to buy 4 or 5 stocks, but the list is daunting having that many stocks out there. So I would get a lot of questions, what are your favorites? And that's how the model portfolio was born. It started on November 19th, 2018. So it's been now in play for more than a year. The results, quite honestly, have been tremendous. Only one down quarter, unfortunately, last quarter. But the quarterly performances have been very strong. And just to give you an idea, the model portfolio currently is up in a year and 10 days. It is up 51.48%. And the S&P 500, by contrast, is up just over 17%. So it's almost a triple on the model relative to the S&P 500. So what I'm going to talk to you about today in terms of creating and designing a winning portfolio, in addition to explaining what we do at EarningsBeats, is I'm going to show you exactly what we look for in coming up with these stocks for these various portfolios. And there are 4 of them. The model portfolio was the first one. That the inception date was November 19th, 2018. Then we had the income portfolio and the aggressive portfolio that were added on May 19th of 2019. And then literally just 10 days ago, we added the value portfolio. So I'll talk about all those. But the first thing I want to do is just kind of walk through what it is we do at EarningsBeats if you're not familiar with us. If you are a member, this will be somewhat of a refresher, but you may pick up some things as well about our membership that can help you. All right, so let me go ahead and go through this. So in designing and creating the portfolios, I am looking for 10 fundamentally sound companies from 10 different industry groups. They're all technically sound as well, and they're meant to be held for 3 months or through one earning cycle, with the whole idea being that the market rotates, leadership rotates, and so we're always looking for the best stocks in the best industries to round out a portfolio, realizing that they're not all going to go up. The whole idea is not, this isn't some magic formula that you get in and all 10 stocks go up and they beat the S&P 500. We know that things change throughout the quarter, but the idea is that there are going to be enough leaders that are performing extremely well to more than offset the couple that kind of fall apart. And that's the essence of what we try to do in creating the portfolio. All of the portfolio stocks come from what we call the strong earnings chart list. So our membership at EarningsBeats, in my opinion, becomes even more valuable if you are a stock charts member. And if you're not a stock charts member, they have a free 30-day trial. So if you're not a member at EarningsBeats and you try the $7 trial for 30 days, you can get a free trial at stock charts and combine the power of both memberships for 30 days for a total of $7. I don't think you can beat it. And you'll get a really good sense, I think, of what we do. But the strong earnings chart list, I go through and literally review thousands of companies every quarter, looking for companies that beat both revenue and earnings per share estimates. They have adequate liquidity. So once I see that they've beaten their the revenue and earnings per share estimates, I look at the chart to make sure that they trade enough volume. If you've got a company that's just beaten revenues and earnings per share, and I look at a chart and all of a sudden realize that they only trade 5,000 shares a day, well, that's not very liquid, especially for a membership of EarningsBeats. I'm not going to provide that. Well, the EarningsBeats membership will control the action in a stock like that, which is not what we want. We do not want to be driving the price, because market makers, there's probably few market makers on a stock like that, because it's not profitable if there are no shares being traded. So you're probably up against one market maker, and trust me, we won't win. So that's not really the type of stock that we want to provide. And then the other thing is, it must be trending higher technically. The chart's got to look good. We're technicians. I'm a momentum trader. I want to see stocks that are trending higher. I don't want to, just because a company beats revenue and earnings per share estimates, Wall Street may not like the company. They may feel like there's too much competition out there, or they may feel like the life cycle or the products isn't long enough, or whatever the reason is. But if a stock is downtrending, I'm not going to buy it just simply because the fundamentals look good. Some might use that as reason to buy. That's just not my style. So again, I want you to get more comfortable with what we do at EarningsBeats.com. We're looking for stocks that are trending higher, that are also beating Wall Street estimates, and that's what's going to make up our strong earnings chart list. Currently, we have 325 stocks on this chart list. And if you're an extra member or above at Stock Charts, and you're also a member of EarningsBeats, we will send you the chart list. You literally can click a button and download it into your account. 325 stocks. All of the homework I do, everything I study over at Zacks, looking at the charts, I annotate the charts. Literally, for $7 trial membership and a free membership at Stock Charts, you can download it into your account in about 2 nanoseconds. All right, next up, relative strength. Very big part of what we do at EarningsBeats. We want to make sure, number one, that an industry group's relative strength to the benchmark S&P 500 is solid, or at least improving. And we want to make sure the stock is a stock's individual relative strength to its peers and the S&P 500 are good. If we get all of that working in our favor, we believe our odds are much better. When we get a pullback, we're going to be much more confident about trading a stock like that. So relative strength is a key. All right, so our service, one of the things that we do, and I'm going to show you how we pick stocks for the portfolio, but the daily market report is kind of, it uses the strong earnings chart list, but it's really a daily report that goes out to our members every day. There's an executive summary in it to highlight key daily developments. So if you're at work and you really don't have time to go through and look at all these different charts, the executive summary will just give you 5, 6, 7 bullets of what's going on that day. So it'll be very quick. You can get right back to work. Literally, it'll take you 10 seconds to look at it. Then I have a market outlook where I'll feature some charts, something that to me is important about our outlook. I'm very bullish, as probably just about everybody in this room knows, from my blogs, from my shows, from the things that we send out to our members. I am extremely bullish. I believe the next decade is going to be a generational type bullish move to the upside, with potential recessions along the way, cyclical bear markets. But I believe if you pick up a Wall Street Journal or you look at a Stock Charts S&P 500, January 1st, 2030, and compare it to January 1st, 2020, I don't know if any of you are on Facebook, but you get those 10-year challenges. The stock market 2030 is not going to look anything like it does at 2020, in my opinion. I think it's going to be a lot higher. So that's market outlook, sector, industry focus. Usually there's a chart in there that might talk about one of the sectors breaking out, or maybe relative strength of a sector, or maybe there's an industry group that you need to be aware of. I've talked a lot recently about biotechs, the fact that that group is just completely caught on fire. So you want to be aware of those things, especially if you're a short-term trader. Strong earnings chart list. In this area, I'm focusing on that strong earnings chart list, those 325 stocks. So for instance, and I'll show you an example in a bit, but I'll run a scan against the chart list looking for stocks that maybe are trading unusually high volume, or maybe testing their 20-day moving average, or whatever. I'll give you the scan code, I'll give you the stocks that meet that list, and then I'll highlight a couple of those charts annotated to show you what I like. So I think that's a pretty nice feature. Active trade alerts. I've pointed out recently to members, this is not designed to replace a portfolio. Active trade alerts are really an educational area of our service, where if we're going, if we like a stock and we put it out as an active trade alert, the difference between that and the charts that you might see under the strong earnings chart list is that these active trade alerts will be managed every day in the daily market report. So it's kind of a way to maybe walk in my shoes the way I would look at a trade. And I adjust the stops along the way. You may not even agree with the way I approach it, which is fine. Everybody trades differently, but it just gives you a better sense of how I view a trade, an active trade. Movers and shakers, that's outside of the strong earnings chart list. So this, you could just be looking at stock charts, looking at stocks that are making big moves one way or the other, or maybe there's high volume on some of those stocks. So this isn't just confined to the strong earnings chart list. This could be anything. And then I keep you up to date on earnings reports and economic reports. Weekly portfolio report goes out every Sunday morning. I give you the portfolio rules and objectives, kind of how I select these portfolios, and give you all the different rules that we look at in terms of coming up with these 10 equal weighted stocks from 10 different industry groups for each of the four portfolios. And I'll talk about that a bit more in just a bit. Snapshot, so it'll just give you a real quick look. It's just a snapshot of an Excel spreadsheet showing you how the S&P 500 did last week and how the portfolios did last week. And then I'll get into the weekly summary, give you probably a chart on the S&P 500 showing you what I like or don't like about the S&P 500, and then go through and give you a pretty good analysis of what took place in each of the four portfolios during the week. So even though it's kind of a longer term, 90-day strategy, I still try to keep you up to date weekly on what's going on with the portfolios. If a stock's breaking down or maybe one's breaking out, that's what that whole thing is designed for. All right, so let's go ahead and get this thing rolling. Let me go ahead and share the EarningsBeats site. Hopefully everybody sees this. So if you're a member at EarningsBeats and you sign into your account, this is what's going to come up. It's going to come up with this left panel. So I could start, for instance, and go over to my blog at Stock Charts. So there's a link in there for that. So right away, if you're into the website and you want to see if there's any blogs that if you're not subscribed to that blog, so you don't know when an article comes out, you can always come in here, check, and it'll link you right in. Trading Places Live. These are 4 shows I do every week, Monday through Thursday from 9 to 9 a.m. Eastern. 2 of them I do here at EarningsBeats, which are Mondays and Wednesdays. The other 2 I do at Stock Charts TV, which are Tuesdays and Thursdays. The Monday and Wednesday shows you can go back and listen to the prior shows on our YouTube channel. So make sure you go back there, like our YouTube channel, and you can check those out. The other 2 Tuesdays and Thursdays are going to be over at Stock Charts, and they also have a YouTube channel where you can check those out. Now, for members, here is the daily market report that I was talking about. So here is your executive summary. This was for Tuesday, by the way. I didn't do one Wednesday, not doing one today, just because of the holidays. But here was Tuesday's report. Just a few quick little blurbs, the executive market summary. Here's your outlook. I love the transports. I'm waiting for this breakout relative to utilities to confirm. While the market was consolidating, while the overall S&P 500 was consolidating, money was rotating more toward defense, less toward transports. I expect we're going to get this breakout. We've had a huge move higher in transports over the last 6 weeks. I think that will continue. As far as sector industry focus, I focused on mid caps. I think it's important. Mid caps and small caps have been underperforming the larger cap S&P 500, but it's worthwhile noting we're getting a breakout. We could begin to see relative strength in the mid cap and small cap. So again, that was something I passed along to our members. Strong earnings chart list. Here is a scan code that I ran. This was simply looking, because the mid cap stocks are breaking out, I wanted to go into our strong earnings chart list, our 325 stocks, and say, okay, in this list, which ones are in the S&P 400 and which ones have a scooter above 90. And if you're looking at scooters, you're talking about relative strength. That's an exclusive feature over at Stock Charts, developed by John Murphy. Scooters, I think, are a great way to just quickly identify a stock that is showing great relative strength. I do want to mention scooters. You know, one limitation on scooters is that if you go in and look at the calculation, basically everything in the calculation is based on how the stock has done in the last 6 months. So you could have a stock that absolutely got killed the last 3 years, but the last 6 months starting to show some strength, and it'll be ranked as one of the best stocks out there. So you want to be careful there. Make sure you understand that. But I think this scan was just a quick way to identify strong earning stocks on our strong earnings chart list that are part of that mid-cap 400 index and those that have shown relative strength in the past several months. So when I ran this, there were 14 stocks that came up, and I listed those for members. They can go take a look at them if they want. But I pointed out a few that I really liked. One's Visteon Corp, had gapped up with earnings, come back down. I see this a lot. Please don't chase these earnings reports. You get these big gap up. Sometimes they keep going higher, but usually, after a day or two, they'll settle down and come back, and they'll give you opportunities to buy cheaper. This is an example of that. So I just pointed out Visteon Corp. Look at the relative strength, by the way, though. Visteon versus the auto parts index. Last 6 months, it's straight up. It's one of the best auto parts stocks out there. Relative to the S&P, great stock. So if you're trying to outperform the S&P 500, why not do it with a stock that's been outperforming for the last 6 months? And do it on a pullback. That's the whole idea. Next stock, MKSI, MKS Instruments, big gap up, pullback. And again, if you jump in and you chase these stocks, and let's say you get into MKSI at 110, you think it's the best thing since sliced bread when it hits 115 in 2 days, and then 4 weeks later, you're scratching your head when it's back down to 102. And worse yet, now the emotions start to get a hold of you, and you decide, okay, I'm going to trade. This isn't what I thought it was. And you get out at probably one of the worst times after you get a pullback. Gapping up, moving higher, pulling back, rinse and repeat. That's how the market works. You want to be on the side of the market maker, not going against the market maker. Remember, when a stock gaps up, market makers provide liquidity. They're on the other side of the trade. That's why most stocks will come back down after their earnings reports, at least for a period of time. Market makers, their number one mandate really is to get price. Well, it's to provide liquidity. So maybe their number two mandate is to get the best price possible for their institutional clients. So when you and me and everybody else is chasing a stock that comes out with great numbers, market makers are on the other side providing liquidity, meaning that they're shorting. And so when they're shorting at the top, chances are they're going to make money on the way back down, and everybody buying at the top is going to panic out. And when they start panicking out at the bottom, market makers are actually buying the shares back, covering their shorts, and making money on that, and then accumulating positions for their institutional clients. It's simply the way the market works, so you got to be aware of that. But again, look at the relative strength. MKSI in the semiconductor group, which has been absolutely on fire. TPX, Tempur-Pedic, another gap up, pullback opportunity to get in on weakness. This one on a relative basis has pulled back the last couple months, but you're getting in very close to a key support area. So you don't have to risk a lot if it continues to weaken. Get into the active trade alerts. This is where I just kind of explained a little bit about what I told you earlier, that really this is more educational on how I manage a trade than it is trying to put an entire portfolio to work 100% of the time. Then the movers and shakers. So this is outside the strong earnings chart list. Here I ran a scan looking for stocks that had traded at least 40% of its normal daily volume during the first hour of trading. And I ran this scan against the small cap index and the mid cap index. Actually, that should have been the S&P 400 mid cap index and the S&P 600 small cap index. And here were the stocks within the small caps. Here were the stocks within the mid caps. And I actually provided 7 different charts that I thought were interesting, that were worth considering. So it's not just a strong earnings chart list. We'll look at some other things as well. I'll try to keep you abreast of everything going on in the market. But personally, I honestly do not trade outside of the strong earnings chart list. I'm a CPA. I passed the CPA exam back in 1984. I was in public accounting for 20 years. I was a principal in a large firm in the DC, Baltimore metropolitan area. And I believe that it's important for management to be trusted. And as a result, that's why, and I have questions sometimes. Well, what if they miss their earnings, but they raise their forecast going forward? And that would be great, except they just, I don't want to say lied, but they just came up short on their estimates. So how do you know that the numbers they're giving for their forecast we should trust them? Doesn't really make sense. If you're missing your last forecast and now you're going to give another rosy forecast going forward, who's to say you're going to meet it? And so I'm much more concerned. I would rather have a company beat and lower forecast than to miss and raise forecast. I'd rather have them be under promising and over delivering. That's the Apple method. So anyhow, you can see all of the stocks there, and then their earnings reports coming up. I try to keep you posted on which companies will be reporting earnings, and then also the economic reports, so that you have an idea of what's going on during the day. All right, let's take a look next at, let's go up here. I showed you the daily market report. Here's the weekly portfolio report, and you can see, again, there's your portfolio rules. There's the snapshot. I'm not going to go into individual portfolios because that will show all of the stocks within the portfolios, and I want to reserve that really for members. I'm going to talk to you about a couple in just a minute from each portfolio. But here was the last week's performance. So this is kind of the snapshot you're going to see each week and update. All right, moving on. Active trades. If we have active trades, you'll see them here. The chart list. All right, so here's the strong earnings chart list and then a relative strength industry group chart list. The strong earnings chart list, we have if you go in, you don't really know what our service is about. This is a great, description of what it is and how you can receive it, what to look for, and that sort of thing. But right now, last update was November 18th. It normally gets updated during earnings season, probably every week to 10 days we'll update it. Outside of earnings season, it'll get updated maybe every 2 to 3 weeks when there's not really a lot of reports coming out. But right now, it's got 325 companies on it. All have beaten Wall Street consensus estimates as to both revenues and earnings, are liquid, and have solid technical charts. And actually down here at the bottom, you can see the strong earnings chart list, and you can go through them 10 at a time if you want. But I want to just point out this one here, CPA, not because I'm a CPA. It has nothing to do with that, really. But they came out with their earnings on 11/13. I'm going to show you a little bit how I developed these portfolios. And I'm going to show you on November 13th how I went in and found CPA. But you can see the stock beat its actual. It beat its the revenue estimate. And so let me just point out first the chart and what that chart looks like right now. So let's go over here to stock charts, pull up CPA, and I'll pull it up on the relative chart. But here was your earnings. And, we saw a couple of charts where the earnings gapped up, and one in particular, MKSI, kept going up for a couple of days. This is so normal when I get these big gap ups with earnings, and then back down we come for a little while. Look at the volume. Look great. 116. Somebody paid $116 for it at the top. And believe me, I've done that before, and everybody in here has probably done that before, where you can look at a day's price action and say, yep, that was mine. I bought it right there at the day's high. We've all done that, been there, done that. But here you can see after gapping up, it pulls back. And this is why I think it's really important to wait until the end of the day to evaluate a stock with a gap. Because if you had looked at this when it was at 116, you would see a gap up and a huge, huge hollow candle, which to me is very bullish. But by the end of the day, it had reversed and come back down. And you can see now we've come all the way back down to where we were the day prior, the low at the day prior to earnings. I actually liked that reversal yesterday. I wouldn't be surprised to see us start to turn back up here on Copa Holdings. But you go back to August and look at the gap up and look at what happened after that. We come back down. I really think if there's one tip that I could give to everybody in the stock market is don't chase earnings. Don't do it. Let them settle down. Do like we do. Put them in a watch list, strong earnings chart list, call it whatever you want. Don't chase. Go back 3 months earlier. Look at this. Huge gap up. Great looking candle. 6 days later, you could have gotten it back down toward the low end of the candle. And this opened at 86 and change, went all the way up to about 96. And literally week to 2 weeks later, you could have gotten it back at 86 again. If you let your emotions get a hold of you when a stock is going up and you just have to jump in on the buy side, it's going to come back to bite you. And same to the downside. If you jump in on the high and then you get caught up in the emotion of the sell-off that comes after that, you're going to be driven to sell at just the wrong time. And it happens to everybody. It's happened to me many, many times over the years. I still will occasionally make that mistake, but I make it a lot less than I used to. And I think the experience and just following these stocks and seeing how they trade quarter after quarter, hundreds of stocks at a time, you start to realize how the market works. Some will say it's unfair. Those who don't follow the charts will say it's unfair, it's unethical, Wall Street's a bunch of crooks. And guess what? They really are, but it's legal. What they do is legal. Market makers, they see the order flow. They have the history of what happens with earnings and after earnings. They know they're going to be able to fill their orders a lot cheaper. So market makers have institutional clients coming to them saying, we want to get into CPA. We want to buy 50,000 shares of it. Well, I can promise you a market maker is not going to go in and put an order in the day of trading or the day of earnings for 50,000 shares. It's just not the way the market works. They're going to be, first of all, providing that liquidity on the sell side. And when everything settles down and everybody starts to panic out, that's when they're going to start building their clients' position. All right. Well, I showed you CPA. Let's go to Zacks. Let me go ahead and just go over here to Zacks. And that was on November 11th. So let me just show you, give you a sense of what I do when I'm building this chart list, which eventually evolves into these portfolios. I go over to Zacks under earnings. I go to earnings releases every single day. So I'll go back. Let's go back to November 13th. That was the day the CPA was on here. So I will go down. First of all, let's go to sales surprises plus. These are positive sales surprises. Put it in alphabetical order, and then I look at all of them. But here is CPA. There it is. So they came out with revenues of 708.21. They had an expected number of 700.96 million. So you can see it was an easy beat, a little over 1%, or right around 1%, more than they had, more than Wall Street was expecting. Now, when you think about it, how does Wall Street come up with their consensus estimate? They go out, they visit these companies, they talk to management, they look at their product, they look at their competition, they look at all these things, and they formulate their own opinion as to what they're expecting. So when a company comes out and delivers better than expected numbers, what do you think they're going to think next quarter when they go out and visit their company? They're probably going to give them a little bit more benefit of the doubt, and maybe even, those whisper numbers might even start moving a little bit higher because they know that they have a management team that just gave them numbers below their actual numbers. All right, so we got CPA beats on the revenue side. Let's go to the earnings side, do the same thing. And there's CPA, 245 versus 231. That's a pretty nice beat, 14 cents higher than expected. So they beat by 6%, or is that, the earnings surprise was 6% higher than expected. I already feel a lot better about this stock. Then I go to stock charts, I pull it up, and I look and I see their volume is pretty good. Definitely an average over 200,000 shares, which is kind of my threshold. and I see the numbers, the big response to the upside, and I'm probably looking at this. I updated on November 18th, so it probably had already traded a couple of days. And so I would have annotated this chart based on where I thought some key support levels were. Definitely the 20-day moving average is one thing that I would look at. Recent lows is another thing. And then I annotate and I add them to my chart list. So let me show you what I'm talking about in my chart list. Here's my strong earnings chart list. Just to give you a sense, if I hit edit list, here they all are. And I put them in numeric order based on the order that they reported earnings. So if I just put AZO in here and I didn't put a number before it, when I pulled up AZO without, maybe looking at the chart, I could tell, maybe when they had reported earnings based on the big volume and maybe the gap up or gap down. But this keeps it, by putting it in number order, kind of keeps it chronological for me. So if I was looking, for instance, this was updated 11/18. Let's say I go to 11/19 and I begin adding another chart. So let's say the last chart was JD, 46.95. Let's say, I know Best Buy just came out, reported good numbers. Let's just say that Best Buy, I'm not sure why that was on a weekly chart. Okay, so here's JD on a daily chart. Here's the annotations, kind of looking at a couple of key levels, support. But look at this one gapped up with earnings and pulls back. You're going to see that so often. Get out of the habit of chasing these stocks after earnings. It's just not worth it. But let's say the next stock. So JD's 46.95. Let me say the next stock that I look at and beats both top and bottom line is Best Buy. And I look at the chart, and the chart here, look at this gap up. First thing I'm going to do, I'm literally giving you the play-by-play of how I do this. I'm going to take this. I'm going to put in here. That looks like pretty darn good area of support. That's where we gapped up from. Probably going to identify, make sure you realize the kind of volume that came in here. Now, am I going to go jumping in and buying the stock? No. It was up to 83.5. Look at this. Just a couple days later, it's already, today it was down to 79 and change. There's a decent chance this stock's going to pull back to 77.5. Maybe even to the 20-day. Maybe, whoops, I don't want to put that in there. Maybe even to the bottom of price gap support, 74 and change. So those are a couple of key areas that I would be watching. Top of gap support, bottom of gap support. Sometimes you'll even see me do this just to identify the 20-day moving average as a possible area. So now I'm going to save this. I'm not really going to save it. I'm just going to show you how I would save it. I'm going to put it in my strong earnings chart list, and I'm going to call this, I think the other one was 46.95. So this would be 46.96, and there you have it. 46.96. Usually I just get rid of all of them. I just do BBY. And literally I would upload, and now the next one's been updated. When I go through all the days, let's say I'll do 10 days worth. Once that gets updated, I'm going to cancel this because I don't want to change it right now. But once all of that gets updated, then what we do, if you're a Stock Charts member, we go into this edit list. Here is all the stocks, and just play along with me. So now I've updated. Now I'm down to say 47.20. I've added another 25 charts. Let's say. If you're a Stock Charts member, we do the send a friend, and you give us your user ID. We type it in, click OK, and boom, the entire list gets sent to you every time it gets updated. That's pretty powerful to have that with the annotations, with the scans in the daily market report showing you. You can go in, look at the charts, the annotations, and see if you like them. It's just a way to provide better trading opportunities. All right. So that's how I update I go to Zacks, look for those earnings reports, find the stocks that beat both, put them, add the ones that look good on the charts and have beaten both top and bottom line, add them to this strong earnings chart list. All right. Next up, let's go to, all right, well, I want to talk about the portfolio. So then I'm going to go back and I'm going to essentially search through these 325 stocks, finding out or figuring out which ones I want to include in each portfolio. Now, the four portfolios I have, model, aggressive, income, and value, are all designed, they're just a little bit different. model portfolio is really the model portfolio is really my favorite 10 stocks. I don't know how else to describe it. I mean, when I'm looking through, that's the first portfolio I fill out. And what I'm looking for, it's not that they have to be a certain market cap, because one stock I'll show you in just a minute. In fact, I'll go ahead and just pull it up and show you now. This is one of the smallest market cap stocks in the entire strong earnings chart list. This stock is under 1 billion. It's probably, I don't know, 800 million market cap. But look at the reaction to earnings. Look at the reaction to earnings back here. This thing gapped up, and notice it went up for 4 or 5 days, but if you were chasing, you didn't have an opportunity. If you come back down, and you can see the stock went from 32 to 27 in 3 trading days, or 27 and a half. You want to try and get a stock after it is pulled back. Now, in these portfolios, that's not really what we do. As an active trader, yes, I would wait for a pullback. From the portfolio perspective, when we announce on November 19th, and let me just put the inspector in here. So on November 19th, the closing price on Ever was $29.73. We had our webinar that night, and essentially we are saying that you want to get in as of the close at $29.73. Now, in theory, that sounds great. If you're hearing it after the close, that's not practical, although just about every one of these stocks allows you to get in at that price. And I think in this last quarter, everyone would have allowed you to get into at least that price. Some of them quite a bit lower. But anyway, EVR, you can see this has been the best performer so far in the model portfolio. It's up another 2.7% today. It was $29.73 on November 19th when it was added to the model portfolio. It's now $35.74. It is up $6, 20% in 7 trading days, 10 calendar days, 7 trading days. Now, that's been the best one. Obviously, there are some that haven't performed as well. Another stock I'll give you out of the model portfolio, Chipotle. Chipotle, I loved this stock. This has been in my portfolio, I think now for the 4th straight quarter in one of the portfolios. I know it got hit here in October into November, but all restaurant stocks went down. If you look at the relative strength, I'm going to pull that up here on CMG. If you look at the relative strength, this is a stock that really has been trending higher versus restaurants for a very long time, and it's near a 52-week relative high right now. So yes, in the restaurants have been bad. I think we're probably going to get a rebound in them, and if we do, I want to be in the leader. And so I think CMG, I think this was an opportunity on this pullback. So I didn't want to miss out on what I thought would be another run to the upside. So we got into CMG as of November 19th, which was the close was 766.78. And you can see you could have gotten in the next few days at that price. But now it is 820.75. So it's up about, I don't know, almost 10%, maybe 7-8%, I don't know, something like that. But another one very strong. The S&P 500, by the way, since November 19th is up 1%, 1.07%. So what we're looking for are leaders to carry these portfolios, and you can see Ever and CMG both doing that. Also, if I pull up Ever, and on this relative chart, you can see relative to internet stocks. Look at the leadership. Again, now we've got internet stocks making new highs, and we're in one of the leaders. That's the idea. Finding good, solid industry groups and then looking for the leaders in those groups. So this all started back in November of 2018 when members asked, what are your favorite 10 stocks? Or what are your favorite 5 stocks? I ended up putting 10 stocks equal weighted into a portfolio and in 10 different industry groups. I mean, when I looked back then, I could have put 10 software stocks in a portfolio, but obviously if software gets hit, your whole portfolio gets crushed. So the idea here is that we're looking for 10 different industry groups that are doing well, looking for leaders within those groups. So after I did this, then members came back and started saying, well, occasionally that and I think one of the stocks I had back in the very first quarterly portfolio for model was EHTH, which was eHealth. And if you look back, This was, well, I got to go back a little bit more than a year. So let's go back a year and a month. So I can look at November 19th. Actually, we'll go back a little bit longer than that. Let's do a year and 6 months. So November 19th, this is when I did the selection. Here was the breakout on earnings. And this one had actually pulled back a little bit. Let's look at the price on November 19th. So as of November 19th on the close, it was $34.40. February 19th on the close, it was $63.57. It was up 85% in 3 months. So that turned out to be a great performer. And that, in essence, carried the portfolio. But EHTH, if you go look at their market cap, was not a very big stock. It was just one smaller stock. Most of the portfolio was much bigger, larger market cap companies, probably at least 10 billion or more. I want to say EHTH back at that time was probably 1 billion, something like that. But the whole idea, again, for the model was to get all kinds of different valuations, different market caps, different industries, lots of variety. Then members came back and said, well, let's do an aggressive portfolio where you're just looking for smaller stocks. And so that's when small cap aggressive portfolio was formed. And it's not all small caps. There's some mid caps. It could even be a large cap that happens to be in a real volatile area. So like a large cap biotech to me is still an aggressive play. So that's how the aggressive was put together. Giving you a couple of stocks that are in the aggressive portfolio right now. So again, to give you a sense, AAXN, this is a defense stock. If we go into the relative chart, but you can see the big gap up here, November 19th. I don't know where it was, maybe around $68. Now it's at $74.68. This is the best performer in that portfolio right now. Another one, GNRC, big move up. This one kind of pulled back a little bit and was near the 20-day. So this one wasn't as overbought as some of the others. And it's made a pretty nice move. I don't know, it's probably up 5% or something here since the announcement just 10 days ago. So those were two leaders there. Well, how about another portfolio? How about those who are a little more conservative, who really don't want to, let's say you're retired, you're kind of on fixed income. You want to be, you want some of your money in the the stock market, but you don't want to be in these high flyers where you got, stocks moving up 80%, down 50%. Well, look for some household names that are showing relative strength. So that's where the income portfolio was born. Companies, most of which you're going to recognize as soon as you hear the names. They're companies that pay dividends. They're leaders. They're larger cap. All the things that maybe make the group not safe, but safer. Really important to understand. Anytime you're in the stock market, you're putting your capital at risk. It's not like investing in a treasury where the government's promising to pay you back. If you're getting in the stock market, your capital is at risk, but there are obviously better, less risky stocks, and that's what the income portfolio tries to do. So, for instance, best performer so far in the last 10 days, Amgen is one. It's a biotech, but it's a large cap biotech. They've got lots of different products. If I had to pick one stock that maybe is a lot less volatile than the overall group, it's probably going to be Amgen. And you can see Amgen's been a tremendous performer. I think just broke out of a base, probably going a lot higher. So what we're looking for here is not only a stock that pays a decent dividend, but also could provide us some nice capital appreciation as well without feeling like you're in a casino in Vegas. Another one, Dover. Dover Corp. This is an industrial machinery company. Long base here, just broke out with earnings. This is a group that has started to show relative strength to the S&P 500, and you got leaders. You got a leader here. Look at the volume trends. Everything looks good here. Another dividend payer, pretty good size company. This is what we're looking for in the income portfolio. All right, and then finally, there is the value portfolio. And now the value portfolio, and I just came up with this. Members didn't ask for it. I was just thinking about it. I always talk about these companies that are in downtrends, and then you get a good earnings report. It surprises Wall Street, and you get a character change on the chart, or you get a gap up, and then it seems to be breaking a downtrend. And I thought, well, what if we created a value portfolio? It's not value in the traditional sense. I didn't go back and look to see what the PE is. I didn't want to make sure the PEs were below 10, which is what some value investors might look for. I didn't go back and look to see what the book value is to make sure that stocks were trading under a certain multiple of book value. That's what I would look for traditionally in terms of value. What I'm talking about in terms of value for this portfolio is more technical value. In other words, a stock that has been downtrending and now could be just starting a major uptrend. And so that, I think, is really important because, and these are probably going to be all over the place, which, by the way, we found out on Wednesday when one of the stocks came out with a bombshell and was down 30%. And even with that drop, believe it or not, this portfolio did so well last week that it's still beating the S&P 500 with one of its stocks down 30%, which is just crazy. Actually, it's probably down 20%. It was up 10 and then got hit. That stock is EVH if you want to pull it up on the charts. But yeah, they came out some ruling in Kentucky or something where the company that EVH bought is not going to be allowed to provide service. I didn't get into a lot of the fundamentals. I just saw the story. And we'll see. The idea is we hold them all for 90 days. So I'm not getting out of it. Members can do what they want with these portfolios. Some have indicated they're going to use stops. That's fine. Whatever works for each member, I think, is what you should be doing. But to give you a sense maybe of something of what's been working in this portfolio, let me give you a stock. This is Sientra in the healthcare space, medical supplies. You see this downtrend, sideways action, you see this gap up. That to me is a character change. So on November 19th, it had pulled back. Another one pulling back since earnings, by the way. You chase it, you pay $9.5 for it. A week later, it's $7.75, and you think it's the worst stock ever. And you think Wall Street's fixed, and don't chase. Let these things come back to you. Here you go. Sientra pulls back. We actually were fortunate to get it on the pullback on November 19th, and you can see since then the stock is up almost 10%. So it's been a really nice performer. Another big winner from this group, or another good winner from this group, is Gray Television Network, GTN. Downtrend. See the downtrend? Sideways consolidation. Here's earnings. Gapping up, breaking this resistance. Looks like this downtrend's ended. And so we were able to get in around 19 and change. Stock just hit 21 a couple of days ago. Now this one, after moving up for 2 days, pulled back but didn't get back to that gap support. The thing is, some pull back beautifully to gap support, others don't. The point is, though, anytime you trade a stock after earnings and you chase, you are putting yourself at tremendous risk. Sometimes they'll keep going, and congratulations when you get the ones that do. Many times they'll pull back, and then it becomes an emotional battle. And we want to try to avoid emotional battles, because if there's one area of the market where market makers take advantage of individual traders, it's through emotional trading. When you're so ticked off because you got a stock at the wrong time. And I don't know if you all have done it. I can promise you I've done it before plenty of times, where you're just looking at it and you're down and you made a mistake and you're like, I don't even care if it bounces. I'm getting out of this thing. It just doesn't make any sense. I'm not holding this. And you sell it. And of course, probably a week later, it's back up to where you bought it originally. That's just the way the market works. But it feeds on emotion. Market makers feed on emotion. If we could eliminate the emotion, everybody would do a lot better. And I'd probably put market makers out of business. They probably wouldn't know how to make any money. Anyhow, actually, they'll still find a way to make money. I always say market makers will sell their family members for $1. All right. So that's essentially how I'm going to create a portfolio. I'm going to go through and I'm going to look for these charts, and I'm going to show you one more thing that I do, because I mentioned the industry groups. I want to show you this list. And we send this out to our members too, but we only send this chart list out to those who are annual members. And the reason being, the strong earnings chart list is constantly changing. Every week to two, it changes. So if we send that out to a trial member and they want to, if they leave our service, then they've got a chart list that'll work for them for a period of time, a few months, at the most, a few months. The strong earnings chart list, this is every industry group relative to the S&P 500. And it's showing up on a weekly 3-year chart. So I've got it here. The first 7 are technology And then I've got them in, I've got, 1 through 7. And then I go into consumer discretionary, 1 through 20. And then I go into the communication services, 1 through 6, 6 industry groups there. And then the industrials, 1 through 16. In other words, I've got every single sector, every single industry group, and this doesn't ever change. Once you get this in your account, you're golden. And you can set it up yourself. I mean, you just have to take the time that I took to set it up. Just go in and put each one, label it, save it into a chart list, and you'll have it. But if you're an annual member, we'll just send it to you. So if you're an annual member at EarningsBeats, we will just send you this chart list. And if you're a Stock Charts member, you just download it into your account. At least an extra. You have to be an extra member or above. Because I think if you're below extra member, you can only have one chart list. So your chart list is when you come in, you have one assigned to you. So if I send you one and you try to download it, it doesn't work because your service level will not accept a second chart list. So you have to be at least an extra member. But I tell you, Stock Charts, that's like the best value in all of finance. I don't even know what I would do if all of a sudden I didn't have my Stock Charts account, because everything I do, as you see, if you're an EarningsBeats member, you know exactly what I'm talking about. Everything we do revolves around using Stock Charts, the scan engine, the chart lists, the annotations, everything. It's pretty cool. Anyhow, yeah, so I mean, each one of these, now look at automobiles relative to the S&P 500 going down. I can tell you there's not a single automobile stock in any of my 4 portfolios. Why? Well, look at the relative PPO. This is momentum. PPO equals momentum, and this is a relative chart. So this is relative momentum. It's been below the 0 line since back in the end of 2017. And if you look at a long-term chart, autos just don't perform well. You'll get, these little surges from time to time, and congratulations if you hit it just right. But for the most part, you downtrend. And so if you're trying to outperform the S&P 500, it's really hard to do it in a group like autos. But let me show you a group where it's not so hard to do it. How about computer hardware? I passed this along to members all the way back in April when we started to show this strength, breaking above the 20-week and the 50-week, turning positive on the PPO. We had one little brief pullback, put in a higher relative low, and then off to the races we go. Apple has been one of my favorite stocks really since back in the spring, early summer, and the stock just keeps moving up. The market loves Apple. The market loves computer hardware. So we should love Apple and computer hardware. If you want to outperform the S&P 500, find stocks and industry groups that are outperforming the S&P 500. Honestly, it's not rocket science. So, of course, you're going to see computer hardware represented in the portfolio. Let's take a look at something maybe that's emerging. I'm trying to think. Recreational products. Let me see if I can find that. Here we go. In consumer discretionary. Now, we had been downtrending for 18, more than that, maybe 20 months. And look at this downtrend. Now, when we break that downtrend and move back through, again, this is relative strength. This isn't telling us that the recreational products has been downtrending for 20 months. Down here, it shows you the actual numbers, which it had actually been downtrending because the relative performance is so weak. But we now have moved on an absolute basis above these prior highs. You see the higher highs and higher lows that are going in? And now we're actually starting to show relative strength, which I think is a great combination. Now, does it guarantee us that this group is going to be the best performer in the next 6 months? Of course not. We could see it completely fall back apart. And you know what? If you're trading a stock, you have a stop in play, you get stopped out. If you're in the portfolios, the idea, again, you should have 10 equal weighted stocks in 10 different industry groups. If one falters, the hope is that there will be others in the portfolio that will carry you. So the whole idea, if you have one that falls apart, well, so be it. You're not a trader. That's the idea of these portfolios. I get questions sometimes from members that'll say, why don't we have stops in here? The stocks are falling back. Some of these stocks have fallen a lot. I get it. Yes, some of them do fall back, but the whole idea here, these portfolios are designed for folks who don't want to trade. That's the idea. You're going to get into 10 equal weighted stocks in 10 different industries, 10 leaders, and you're going to hold them for 90 days. And we're going to go through this whole process again, and we're going to find 10 new ones. And you're going to keep doing that every quarter. And as I pointed out earlier, the model portfolio over the last year and 10 days is up over 51%. The S&P is up 17%. I'm not going to change something that's not broken. All right, so anyhow, that's kind of the whole idea. I mean, it took about an hour. I'm sorry it took so long. But I wanted to give you a really good idea of what we do at EarningsBeats.com. And I do want to also mention this to all of you who are non-members of EarningsBeats. If you came in a little bit late, if you're a member of EarningsBeats, you save $20 on the Market Vision 2020 event that's going to be held on Saturday, January 4th. So you're going to pay $20 extra. If you become an EarningsBeats trial member for $7, you save $20 on that event. So if you're a non-member of EarningsBeats and you like what I talked about today, and you're coming to the event, or you're planning to come to the event, or you even think you might be coming to the event on January 4th, sign up for the trial. Just go to our website, and I'll show you exactly how you can get there. Just go into EarningsBeats. And you can go into, I think it's About Us, and you can see the Join Today 30-day trial special. But you can go in and you can try us for $7. And if you've already paid as a non-member and you sign up, send us an email. Send it to support@earningsbeats.com. Explain to us you just became a trial member and you'd like to get the member rate on the event if you've already signed up. Now, if you sign up for a trial and then sign up for the event, it'll automatically happen. But I'm just talking about for those of you who have already signed up as a non-member, which I think for today, Black Friday is $137. I think it's $137, or maybe it's maybe it's $147. Whatever it is, if you come in and you sign up for the $7 trial, you will just send us an email, support@earningsbeats.com, and we will make sure we refund you $20. So in essence, we'll pay you $13 to try our service, which that's a pretty good trial offer. All right, I'm going to go ahead and wrap up. I want to thank everybody for coming in. It was great. If you need to come back and look at this presentation later, it has been recorded, so you will be able to check that out later. Yeah, really appreciate you coming in. Again, happy Thanksgiving to everybody that has already celebrated here in the U.S. and to anybody who's celebrating. And enjoy the rest of your weekend. Market, by the way, closes in an hour. It closes a little early today. But have a great day. Enjoy your weekend. Be safe over the holidays. And hopefully we'll see you back on Monday for my Trading Places Live. Everybody take care.